Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, August 2nd, 2022. Welcome back to the podcast, George.
Good to be back as always.
Yeah, good to have you. Let's get right into it. So the Treasury market continues to experience significantly elevated volatility. Last week was no exception. Somewhat ironically, I'd argue the Fed raised rates by 75 basis points again, but the broader markets honed in on what I, and others probably call the dovish delivery of the message, if you will. So I guess the question, George, is do you agree with how markets interpreted the Fed? And they seem to be doing some reinterpreting today. And where are we in the Fed cycle? Or said another way, when does the Fed pivot from inflation concern to recession concern?
No, yeah, it's been pretty amazing, the price action, to say the least, John. I mean, last week, on the back of a 75 basis point increase, we had real rates almost rally 50 basis points in the last couple of sessions. I mean, there's been a pretty big rally lower in real rates. And tips have seen break-even compression. Tuesday's price action notwithstanding, we got rates pretty low pretty quickly in a matter of 3-4 days. The 10-year got sub 260. And to me, that felt overdone. I think the market, in a way, has been kind of gotten comfortable with the idea of guiding the Fed to action, and so it's almost like as if the market was trying to see if they could, kind of push the Fed towards pivoting earlier. And as we've heard from recent Fed speakers post the meeting, they're clearly indicating that they're nowhere near being done with the tightening of policy. And that's largely because inflation, even if it's from a headline perspective, perhaps has maybe peaked. And again, that's debatable. We have to see what happens. There's still a lot of moving parts with the energy component, which is outside the control of the Fed altogether, which is why they usually typically focus on core, which also will stay pretty sticky as well. So it's hard to say that, even if we have seen the peak or the near peak of the big headline annual numbers, inflation still will stay pretty high, and the Fed has to react to that. And for us, on the strategy side here at MUFG, we think that there will be a time for the Fed to pivot. I just feel like last week was not the time. This was just more the dovish signals in the market, kind of running with the idea that, with Chair Powell mentioning that they're now close to neutral, and that again is a long-term neutral target of around 2.5%. It doesn't address the near-term inflation risks, not enough at least. And so I feel like the market got ahead of itself. It's kind of reassessing now the big moves. We still have a number of hikes still ahead for the year, in our view. Even though we've been more dovish than the street on average, we still think that the Fed still has to deliver a hike, a meaningful size hike in September, and then probably start dialing it back in November. And we'll see as the data evolves. But nonetheless, the pivot is not there yet. If they're going to signal the pivot, I think it's going to come after seeing a lot more data in the next 2 months. It's a risk that it happens in September where we get the criteria for why the Fed will pause and go to smaller hikes or maybe stop altogether. But this surely was not it. And this is the market trying to force the Fed's hand, in our view. And I think, now we're going to see the unwind of it.
Yeah, I couldn't agree more. I mean, huge rally in the days or weeks, or whatever that followed the Fed, and I think the sell-off in the Treasury market that we're seeing today. Again, we're recording on Tuesday, August 2nd. Makes a bit more sense. I think you said in your piece that in another piece how the Fed will pivot, and it's not but today wasn't the day. And I think you also pointed out that piece, and you highlighted here today that you kind of said that they're going to be, the pivot will be determined by inflation. So in it kind of making a related point, the Fed's put was always predicated on having low inflation. Until that goes away, they're going to be constrained to how how easy they can be, right? So
exactly.
So moving on, the next major market event following the Fed was the release of Q2 GDP. The release showed the second consecutive quarter of negative growth, which which is the definition of a technical recession. Whether we're in an actual recession or not remains to be said. But similar to kind of the move after the Fed, all asset classes rallied on the print, suggesting the Fed's going to come to the rescue, if you will. I know you've been focused on weakness in the data as of late, so I think the best question is right now, what is your take on recession risk?
Sure, and look at like the market again, under this guise of bad news is good news, it led to that sort of reaction on GDP days and the days afterwards. Again, also an overreaction. Like our view has been, we've been calling for a slowdown in 2022, all since the beginning of the year, quite frankly, and the slowdown actually happened much sooner, and it is still evolving. I think that the challenge of if we are and have experienced a technical recession in the first half, that's behind us now. That's in the rear view mirror. But looking forward, I mean, the risks of a more proper, sustained kind of recession is still relatively high. We were ahead of the consensus for quite some time. We started off the year roughly around 30%, and then consensus moved to 30%, and then we moved a couple of months ago to 60% of a base case for recession happening in the next 12 months. And now consensus is roughly at 47.5 as of the latest Bloomberg readings. I think that the question that we have to ask ourselves is really, how do we not fall into a proper recession? So, putting the first half technical recession, which can again be revised. I mean, the numbers always get revised over time, and it's possible that we don't have enough information to really conclusively say that first half was a real recession. Even if it technically looks optically as 2 quarters of negative growth, it could get revised higher. So we don't want to. I'm not going to hang my hat on our recession call based on that view. It's backward looking. We're paid to look forward and thinking about what lies ahead, and some of the indicators that I think we cannot dismiss. And the bond market is probably the best weighing machine out there. And I think what the curves have been pretty clear really since the start of last year. You have the euro dollar curve starting to invert really in the forwards, in the deep forwards, and then as the year progressed and as the Fed started raising rates in 2022, we got further and further inversions in the cash treasury curves, and now we're at a point where it's pretty much an upside down curve, except for certain points around the 20-year relative to tens. So I feel like like that is probably the best indicator. Still, I still think the curve and the fact that we've seen inversions is a good indicator that we're likely to see some sort of recession. The bond market is a great kind of a collector of views across various investors. But just looking at the actual data, I spent a lot of time looking at the ISM data, which we got an update also this past week at the ISM for manufacturing, looking at new orders versus inventories, that spread continues to get worse, and it's falling pretty quickly, almost like what was seen in the 1970s recessions, 1974, 75 recession, where all of a sudden you had a price shock to energy, you had a reaction from the Fed raising rates back then, and then pretty protracted and fast slowdown during that period. And it's quite possible that we're seeing a similar repeat, where enough deceleration is happening in the economy, the Fed's still reacting to the inflation because it has to really ensure that price stability is achieved, and by doing so, they run the risk of the U.S. falling into a recession. Not their intent, but it's could be the final outcome in a much more proper type recession across various industries, and then ultimately resulting in the labor market getting hit. So I feel like that's what still lies ahead of us, and so that's why there's the risk for rates markets are that the bond market is sniffing this out, and that's why the curves are staying inverted and long-term rates are staying lower than short-term rates, and we'll probably excuse me, probably continue to do so for the months and weeks ahead. But then at some point, in 2023, we'll probably see the other side of the trade, and the curve will start to steepen. But we're nowhere near at that point where you should put on those sort of expressions. it's more likely that we'll see the inversions persist, the Fed keep raising rates, and it's going to result in eventually credit markets coming under more pressure, and then equities again seeing another potential downdraft into the fourth quarter.
Yeah, so it sounds like a lot of wood to chop between now and then, but as you've said many times, the yield curve and the market just itself is the best forecaster on the street. So I guess our listeners should take note. And for more, I would encourage our listeners to see the recently released and very comprehensive publication, Mixed Signals: An Assessment of U.S. Recession Risk in the Year Ahead, which George co-authored along with the MUFG Capital Market Strategy team. Great stuff as always. Thanks, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.